Hi friends, our next topic is adjusting general entries. Next is why do we need adjusting general entries? The answer to this is accrual basis of accounting. We all know that we have to prepare financials on on accrual basis of accounting rather than cash basis. So in accrual basis accounting, we have to match revenues with expenses. For example, you are providing some accounting services to some client in January month, and for that accounting services you have rented out a building for which you have to pay rent on 31st December, like in advance. So like revenue will be for January would be booked in January only, but even if you have paid rent related to January month on 31st December, you have to book expense for that rent in January itself, because here you have to match revenues with expenses. So revenues are booked in January and expense would also be booked in January itself. Let's read out. Accrual basis of accounting is in accordance with US GAAP and matches revenues with expenses. So some examples of adjusting general entries are where we have unearned revenue, we have prepaid expenses, accrued revenue, and accrued expenses. So before explaining these terms to you, I will tell you that every transaction has two aspects. One is when the cash is received, yeah, cash is paid, and when that revenue or expense is actually incurred. So when one of these aspects is completed and other one is pending, we have to make adjusting journal entries. So the meaning of unearned or prepaid means cash transaction is complete but earning expense is pending. And accrued means earning or expense is completed but cash transaction is pending. So this happens is, for example, this is the timeline and this is your year end. So for unearned, the cash is received before this, but earning or expense is after this. And in the case of accrued, it means that earning or expense is completed before the year end, but the cash transaction is pending and is completed after the year end. So in that case, we have to make adjusting general entries. Adjusting general entries. So let's discuss unearned revenue and prepaid expense. Unearned revenue means when cash is received but the revenue is not earned. That means, let's say for accounting services which you will provide during January month, you have received the payment on 31st December. In that case, what entry you will be booking? This would not be like the entry on 31st December would not be booked to revenue because you have not earned it. So in that case, the entry would be cash to unearned revenue, and here unearned revenue is a liability account. And whenever you have completed the services that you have given the services to your client, then only you can book the revenue, and at that time you will be booking the adjusting general entry, which is cancelling out unearned revenue and booking the revenue. Same is in the case of prepaid expenses. Whenever you pay the expense and it is not incurred, then you will just book prepaid expense to cash. Here prepaid expense is an asset account because you have not incurred that expense, but still you have paid it to your vendor. And when you have incurred those expenses, you will cancel out the prepaid expense account and book it to expense. So other two adjusting general entries are accrued revenue and accrued expenses. So accrued revenue means you have earned a revenue but you have not received the payment for the same. In that case, you will have to book the revenue, and the revenue will be booked with respect to the customer. That would be the account receivable. So the entry is account receivable to revenues, and whenever you receive the revenue, then you will remove the account receivable. That means you will credit the account receivable and debit the cash. Adjusting general entry for accrued expenses. Here accrued expenses means you have paid sorry, not paid, you have expensed, you have incurred the expense but you have not paid for the same. In that case, what would be the general entry? You will debit the expense and credit the accrued liability, and whenever you pay for the expense, you will debit the accrued liability and credit the cash. Next is rules for recording adjusting general entries. So first rule would be adjusting general entries must be recorded by the end of the entity's fiscal year. This is easy. Then second would be adjusting journal entries never involve cash account. So for example, in case of unearned revenue, what was the first entry? It was cash to unearned revenue. So this is not adjusting JE, because this is normal. Like when you receive the cash, you will book an entry from cash to unearned revenue. The adjusting general entry in that case was crediting unearned revenue to revenue when you have actually earned that revenue. So adjusting general entries are used to accrue or book revenues or expenses. So it never involves cash. Then the last rule is it will always hit one income statement account and one balance sheet account. As I've told you, for unearned revenue, what was the adjusting journal entry? Cancelling out unearned revenue and then booking revenue whenever it is earned. So in that case, unearned revenue was balance sheet account and revenue was income statement account. So adjusting journal entry would never involve cash, one thing, and it will always involve one income statement account and second balance sheet account. Thanks for watching. Here are some of my social media handles where you can reach out. Thank you.